What I want to run through today is some of the investment activity we've seen over the last 12 months, a little bit about the investor universe and some of the new capital coming into the sector and what's attracting them. And I'll finish by sharing some of the findings of our recent UK-focused healthcare market sentiment survey. If we look at investment volumes, we'll see that in the context of a challenging year, it's no surprise that investment volumes were down by about 20% overall. But some sectors were hit harder than others. Hotels, retail, and offices were impacted. Offices being such a large part of the investment universe has a big hit on overall volumes. Travel was difficult and many investors were restricted in what they could transact, leading to an increase in domestic activity across the region, often in smaller ticket sizes. But healthcare volumes remained robust and actually increased year on year, with investors generally seeing that the outlook for both public and private investment into the sector would be stronger going forward. With this increased interest, unsurprisingly, came pressure on yields, and we saw some contraction across 2020. But this contraction really follows the long-term trend, and we've now seen that there's been a substantial contraction over the last few years, and average yields across the sector are now around the 4.5% mark, which still offers a premium to prime offices and an interesting spread to bond rates for investors looking to get exposure to the real estate universe. Now, this yield pressure comes in part from the increasing institutionalization of the sector and an expansion of the investor universe away from just the traditional sector specialists. Many institutional investors now recognize the attractiveness of the sector, and with increasing transparency, they're much more comfortable investing directly. Operator selection remains a variable in the equation, though, that few are prepared to compromise on. Reputational risk remains of primary importance for many of these investors. It would be remiss not to mention the increased debt liquidity we've seen in the market as well, as this is a key facilitator of some of the trends we've been discussing. We've seen an increase from not just the banks, but also from the large debt funds and the investment banks, all trying to access product that they feel comfortable with on the right underwriting terms, and again with the right operator. But both the equity and debt remain focused on some common ground. Modern purpose-built facilities, preferably meeting or capable of meeting new ESG criteria, remain primary. Resilient locations. There's been an increasing focus on urban as well as suburban locations, and we feel that that trend will continue. Comfort standards are also on the rise in the wake of increased but discerning demand. Triple net lease structures remain attractive, and the longer the better. But investors are not seeking to push too hard on the EBITDA levels, and they want to have operators operating within a comfortable zone. Modest but inflation-linked indexed rents are also desirable, and investors, again, will be very attracted to that kind of income profile. But as we've said, the sponsor and the track record of the operator remain probably the most important criteria. And that wraps up the quick focus on the investment market. So moving to the healthcare sector intentions survey, we surveyed a number of our investor, operator, developer, and lending clients about their experiences over the last 12 months and their sentiments for the year ahead. Starting with investors, nearly all those surveyed wanted to maintain or increase their allocation to the sector, with a similar number believing that demand will continue to rise, and over 80% believing that pricing will reflect this and remain stable, or most likely increasing. Quality of stock remained an important factor, with 40% believing that COVID-19 will actually have a direct impact. Maybe again, not surprisingly, the focus of most of the interest was in the less specialized end of the healthcare asset spectrum, with elderly care and senior living being the most popular amongst those surveyed. Nearly 40% of those surveys would seek to reduce risk, and popular ways to do that would be through longer leases and stable or lower leverage. Quality stock is another way to ensure that your asset is defensive and can respond to any future changes. Moving to the developers in our survey, 60% had said that COVID had not impacted strategy, and nearly 50% thought that there would be increased projects throughout 2021. Increased construction costs were of some concern, and a direct consequence of the pandemic was being felt on the design and layout demands of clients. Financial viability of a scheme requires a thorough assessment of the affluence of an area and its population density, and that remained of utmost importance for the developers. Development teams witnessed increased activity, but more so with the specialist developers, as the operator developers focus more on the operational challenges brought about by the pandemic in their existing assets. Again, we see a leaning towards the less specialized end of the sector as offering perceived greater opportunity. Many of the operators that we surveyed said that they'd experienced decreased occupancy due to the pandemic, but the private rates were maintained by many of them through that period. Many of them believe it will take some time to recover, and many of them are seeking to grow their assets through leases of some sort, rather than tying up capital in ownership, which has been a traditional model. The respondent type was balanced across the financial sponsor-backed, family businesses, corporates, and not-for-profits. 75% said they'd experienced a decrease in occupancy, and 80% thought that it will take less than 2 years to recover to pre-COVID occupancy levels as confidence returns with the vaccine coming through. Finally, to the lenders in our survey, same story, 72% are interested in increasing their exposure to the sector, and 65% were prepared to take on more development risk as a way to access quality product in a competitive market. Again, we see the tendency towards the less specialized end of the spectrum, and retirement living is the most popular, with over 90% interested in increasing their exposure. Interestingly, multiples remain stable as margins increased, but we have seen some willingness for lenders to increase their LTVs. And it's back to you, Richard. Thank you.